Netflix is an American over-the-top content platform and production company headquartered in Los Gatos, California. The company's primary business is a subscription-based streaming service offering online streaming from a library of films and television series. And as of July 2021, Netflix had 209 million subscribers, including 72 million in the United States and Canada. It's available worldwide except for some jurisdictions, and company has offices in different countries as Canada, France, Brazil, and so on. So right now we would like to compare together pros and cons of investing in Netflix. Let's start with advantages. With 167 million subscribers across the globe, often shared with and between households, the actual leadership across the globe is very dominant for Netflix and is and was the undisputed leader in this industry despite emerging competition. The company started 2020 with 28% revenue growth in the first quarter, albeit accompanied by a big improvement in operating margins, as already guided for. The company added more than 15 million members during the quarter, clearly driven by the impact of the pandemic. Netflix started 2021 on a softer note, as first quarter membership additions of 4 million were a bit softer than the 6 million guided for, important as the competition is only heating up across the globe. Despite the softer additions, its underlying results, which are still solid with revenues of nearly 7.2 billion being up 24% year over year, as operating margins of 27% improved more than 10% from the year before. As of concern remains the free cash flow aspect, but due to management expectations, by the end of 2021 we will be near the break-even point in terms of this one indicator. It means that there will be no significant increment in content production. Potentially, Netflix could significantly increase the free cash flow that investors are worried about by slightly lowering investments in content. And as of every single stock, there is also some concerns regarding future performance of a company. So right now, headwind for the company might be a growth that mostly coming from overseas. So right now we are in an area where US membership basis declined over the past quarter. This creates a drag on margins, with average prices being the highest in the US. So we need this interest of clients from out of US, otherwise the growth will be a little bit threatened. Netflix competitive mode is right now starting to seem even more prominent than it was before. Even if Netflix produces the most significant amount of unique content, there are more and more brands that are trying to compete on this very, very attractive market. In terms of earnings, the remaining price earnings multiples are high, as the company has some headwinds in terms of slower growth in net additions, as we mentioned before, and undoubtedly the problem is about to get bigger if the competition just speed up in its growth. And right now the aspect of continued user growth is under a concern of lots of analysts. And covering up this topic, to some analysts it's hard to believe to invest in a business whose capital expenditures are growing faster than revenue, and adding up content investments resemble capital expenditures, but investments amortize more quickly. In terms of valuation, I'd like to bring over some indicators that may show up where we are right now with its Netflix growth. So the PE ratio multiple is 53 points, the lowest in the last 8 years. PEG is less than 1 right now. However, an EV to EBITDA multiple makes Netflix traded lower than the Walt Disney Company, 35 versus 37. despite the growth in financial performance last times. In order to conclude, we need to bear in mind that stock has risen just about $100 or just over 25%, marking a dramatic underperformance versus some other technology names and in fact the wider market. So this is interesting right now as Netflix sees continued growth. The large numbers and increased competition is weighing on the growth pace of this company. Right now, despite growing revenues and profitability, the market recently became more skeptical of Netflix. The reason is definitely heightening competition and increasing doubts about the company's ability to generate free cash flow. Right now, the company is about to continue its growth and its revenue at high rate. However, the driver will be the international market. Otherwise, the growth won't be sustainable. The market of Netflix is with a great potential as the current traction and infrastructure make Netflix one of the few and better positioned names to move into this huge market, albeit that this is likely a multi-year effort with unpredictable outcomes beforehand and likely a smaller potential market based on the user count. We need to remember that Netflix produces the most significant amount of original content today, and unique content is the main battleground for streaming platforms. Okay, so you've just got a viewpoint on where Netflix might be heading in the future regarding its fundamental analysis. Right now, let's look at technical analysis made on 25th of August that might find some good entrance that will maximize our profit of investment. So we are right now consolidating within this area of 460 and 560 area. This area has started forming into something like a ascending triangle, typically bullish formation. But this consolidation is making us more and more bored with this chart, as it is long lasting and it's already has just started on July of 2020, and it's 12 months since we just got to this 560 bucks. So we need another catalyst to move the price upwards. In order Netflix to move higher, there is very important, very strong earnings and also free cash flow to be achieved. Otherwise, we would just hold this consolidation even longer, and it may extend to this even nearly 3 years period that we were holding throughout this 2018 and 2020 period.